My fundamental analysis is showing 3 bullish and 2 bearish across the majors right now. But between a pair that's conflicting across time frames and a central bank that could step in and wipe a trade at any moment, not everything your 2 flags is worth acting on. Let me show you exactly what I mean. So if you're out there and you want to see what forex trading really looks like, this is the channel for you. Like, trust me, this is the channel for you. This channel is the raw documentation of actual progress and regressions that a person who is into forex seriously and also has a 9-to-5 job is like. This is literally the whole shebang. So we're going to start from the most bearish, which is the British pound against the new US dollar. And as what I see here from the fundamental startups here is that price is rated as bullish, but this is something you need to watch out carefully. The sum product is the total score after I run up on my calculations on this sheet. But what got us to 63.5%? Well, let's take a look at the high impact data. The high impact data altogether is currently at 46.5%. which is bearish somewhat. It's kind of neutral, but towards the bearish side. And then we have the high impact 14 days news release. So in the last 14 days, all the high impact news for the British pound and the US dollar, when you compare all of them, we are in the neutral zone again. But on the chart, the previous day, all the way till long ago, the daily technical direction is at about 100%, meaning it is extremely bullish. What does this 100% mean? If you go look at the 20 and the 50 SMAs of the chart, you realize that the current pattern is heavily bullish. The non-commercial traders are actually much more long in the British pound than they are in the dollar, and the commercial traders are hedging risk, hoping that they would keep up the dollar than the British pound. Now, with all of this in mind, let's see what the chart is saying. Okay, so looking at the chart currently, my chart is kind of muddled with lots and lots of lines and boxes, but don't worry, we're going to clean it up all now. I'm just doing this for you guys to see what I'm saying. Now, the SMA, this is the 20 SMA and 50 SMA, and you can see it is very green over here, showing signs of an extremely bullish market. You see how wide that spread is. Now, let's take this out of the chart and let's focus on what the chart is saying itself. Now, in the chart itself, we can see price finally tipped back into the last candle of the daily zone. And with the supply and demand strategy on the 4 hours, I am looking for show of strength, right? Show of strength. I'm looking to either see a hammer or a very good bullish engulfing bar. And you can see I have it set here, but I'm not in any trade because we don't dive into any trade just like that. We dive into trade when it's worth taking a trade. Now, people will say confirmation is a bad thing, confirmation is a waste of your time. That's their business, right? That's their business. I trade the way I trade, and I like to trade the way I trade because I see profit with it. I have a trade ongoing where I'm seeing good profit, and that is just by the wayside. Now, for the US dollar against the British pound, or the British pound against the US dollar, price has come down into the daily and a 4-hour zone. This is a zone where I am looking for, like I just said, a candle, a good bullish candle. That is an engulfing bar or a very good pin bar to the upside. Those are the two things I'm looking for. Once I sight that entry, I'll take it. Now, I'm not too sure if it's going to take me all the way up. Not too sure. Why? Because trading is all about probabilities. Price may still come down for this weekly demand zone instead first. It's possible, but what the fundamentals are saying and what the calculation is saying, this market is majorly being powered by the non-commercial traders. So looking at that upside, look at it with a grain of salt. Moving on, we have the Australian dollar against the US dollar. Now, another thing I noticed here is the fundamentals, right? The total score is around the 58%, which is just walking into the bullish camp. It's not really bullish, in my opinion. It's just walking into the bullish camp. However, take a good look at the situation right here. The fundamental situation is saying 42%, which is leaning towards the bearish side. The 14 days release is also 51%, which is similar with what we have with the British pound against the US dollar. Then we have the technical direction, which is currently bullish. But this is where we have a little bit of situation. The non-commercial traders are not so bullish in this market. And also the commercial traders are also not so bearish in this market either. They are just flatline. And this kind of scenario makes you think about what you're doing, right? Let's take a look at what's happening on the chart. Now, here on the charts, I'll tell you one funny thing. Price is dancing just slightly away from the 4 hours demand zones I have on my chart. This is me watching out for some daily zones. And you can see I have a trend line here. I'm just watching price. Was hoping for price to come down into the trend, dig through the trend line a little bit for us to buy and then follow the trend to the upside. We may see that happen anytime soon, but currently what I'm seeing price doing is price is running away from us. Even though the non-commercial traders are not so long in this market, it doesn't mean the market could not still continue for an upside. Again, the market is going to move as it pleases. It can continue for an upside for a long time before it even pulls back. But I'm just personally waiting. I'm really hoping to get that that small pullback to the downside, and that way I can then trade into this market and possibly buy if the fundamentals support it at that point anymore to buy. If it doesn't support it at that point in time, I'll chill from the market and let it be. Moving on, we have the last but not the least, the one that's actually the least bullish on my chart. We have the New Zealand dollar against the US dollar. Now, the overall impact is actually better than that of the British pound and the Australian dollar. However, in the recent 14 days, they've had more good news for the dollar than they've had for the New Zealand dollar, right? The US dollar than for the New Zealand dollar. The direction of the charts is not so super bullish anymore, right? It's bullish, but not like extreme. It's usually bullish. The non-commercial traders, still believe so much in the New Zealand dollar, and this way, it means one thing, right? It means one thing. Price is coming into a zone where we may likely see an opportunity to buy. But when I go to the chart, let's go into the chart and see what it looks like. When I go into the chart, what I see here is price has come into a previous daily zone and is quite close to a 4-hour demand zone. And in my opinion, just like as usual, I'm praying for price to actually come into the 4-hour zone and show signs of strength to the upside. Then we'll look to come into this market and take a buying position. Now, with all of this, we need to flip the whole situation. We're flipping the situation to one thing, right? One thing. We are moving into the bearish side of the market now, and we're going to start with the less bearish one. We're going to start with the US dollar against the Canadian dollar. As you can see right here, the sum product is around 40%, right? 40%. However, the impact news is at 60%. Now, one thing is confusing right here. It's quite confusing. There's a little bit of nuance to this situation. What we are seeing here is a market that says, let's go bearish. However, the fundamental is not agreeing with that perspective. Even though the last 14 days, as you can see, it's having similar situation where the US dollar is more favored fundamentally, like economic data release, compared to the Canadian dollar. And then we have the technical direction is showing us an absolute sign of crashing in the market, sell everything, panics and runs. The non-commercial data is in similar situation, right? The non-commercial traders, they had much more belief in the Canadian dollar than they have in the US dollar. While the commercial traders, the hedgers, the guys are hedging risk and saying, well, we could still buy a little bit more of the CAD slowly. We could start buying the CAD slowly. Now, the thing about commercial traders is they tend to buy the dip, but they don't go make the mistake of buying the dip in the sense of you just buy as much as possible. No, they buy in tiny chunks. So we can see them buying the dip. They are literally buying this dip as it goes, and they are hoping that when this thing turns to the other side, they will make profit. But let's take a look at the situation right here. Like I just said, even though my tool is saying this market is bearish, right? Price is giving me signs, rather I'm not even in price yet, but looking at this data, it's giving me signs of reason not to come into this market yet. Now let's see if the chart is going to make it even more evident or not. Now moving on to the charts, this is what I'm looking at right here, and you can see the skepticism from the analysis is also kind of showing up here a little bit. Why do I say so? Now, if you look into this chart, what I see here is this. I have a clear daily zone right here. This is a very clear daily zone. But we can see price already poking above it. You can see price is breaking that structure, poking above it, creating a very, very fine trend line to the upside. You can see that trend to the upside, really, really good one. And it's been keeping up that trend even stronger. It went up a start for a start, and then it went up even better at this point. And you can see it's trying to sustain that trend line to the upside. Well, in my opinion, this is a good situation where I would not place a trade yet. Why? Because right above it, just like the British pound against the dollar and the New Zealand dollar against the US dollar, we have a weekly zone somewhere so close to it. Now, these are situations where price may find its way and say, okay, let's move more into, let's dig in deeper. It could be a squeeze where the traders want to squeeze out of the money, right? The big guys could decide to run a small squeeze and let this market run up as high as possible into the weekly zone before the selling really comes in. So for me as a normal trader, for me as a retail trader, my opinion is personally to sit this market out and see if it starts to break all these trends, if it starts to break through this trend and finds its way proving move to the downside, right? It starts to prove moves to the downside. When it starts to show me moves to the downside, I will come into this trade. But for right now, I'm kind of skeptical of it. And even though my tool is screaming sell, 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 I don't see me selling unless I start to see clear reasons. Even though, remember I told you guys I need to see either a pin bar. This is a bearish pin bar in this occasion, which as you can see right here, there is a bearish pin bar right here. Clearly, this is a bearish pin bar. And I also said if I could see an engulfing bar. And you can see right here, I do have a bearish engulfing bar right here. However, that skepticism is still there. I want to see not just an engulfing bar. I want to see that intent to go to the downside. I want to see that intent for the markets to push to the downside. This market is actually 0.2% in the positive today as of right now. That is from open up markets to now it is currently in the positive. So we kind of have to be kind of careful with how we place these trades. Moving on to the last but not the least, we have the one market everybody constantly has been looking at recently, the US dollar against the Japanese yen. Now, this is kind of the most bearish thing in the major market. It has a 37% stance right now. But looking at the high impact data, right, the fundamental information, the economic data in the market is quite bullish, including the 14 days release. It's also quite bullish. But the technical direction is absolutely bearish. Add that to the fact that the non-commercial traders, the profits traders, are shorting this market heavily. Now, when I say they are shorting this market, they are going more for the yen than they are going for the dollar. That's just what it means. It doesn't mean that they are selling every dollar in their accounts. They are buying more yen than they are buying dollars. That's basically what it means. And then the commercial traders, the guys who are trying to hedge the situation, the buy the dip managers and sell the rally managers, they are slowly, you can see it's 64%. They're actually buying into it. By the time they get to 70%, you know that they are seeing it as extremely cheap to start buying as much dip as possible, but it's not there yet. So they are going in slowly into this market. Now, let's take a look at what that is on the chart. And voila, this is what we have on the chart. Now, I personally didn't mark up this chart for a selling situation, but I'm going to just show you guys exactly what the selling situation is for somebody like me. For somebody like me, I'm going to start out on the weekly. I'm just going to do a small analysis of how I look at the market when I trade. Now, on the weekly, I have this weekly demand zone, as you can see already marked out here. So let's mark out the weekly supply zone alongside with it. Now, for the weekly supply zone, I have this whole area. This whole area to me is a very credible supply situation. I can supply and make money. It's expensive area to sell. Now, wow, it's not really expensive. One thing you need to understand about demand and supply is not about just expensive and cheap. It's more of there were more people here ready to sell those markets. So if price comes back here, are those people still going to be here to sell? And do we want to join them to sell? That is what it means. Now on the daily chart, where did this whole madness start from? Well, this whole madness started from here, right here at the very extreme edge. This is where it started from. However, on the same daily, I saw a possible small madness. Now this would have been a good daily zone if this candle was able to maintain its hold to the downside. But this is not a good daily zone because the candle was not able to maintain its hold to the downside. Instead, price came down, found a lot of people ready to buy as they saw it as a valuable price to buy. And you can see creating those wicks around here a lot of times. And then on the 4 hours, on the 4 hours, this looks like a credible sell area, right? On the 4 hours, that's when it looks like a credible sell area. But again, it doesn't have that coverage of a higher time frame. So it's less powerful than it is useful to me. So I call this a weak supply zone. So to me, this is like a weak supply zone. It's not really strong. However, the strong 4-hour supply zone I have is right here. And you can see it's much more engrossed in the higher time frame supply zone. And this is how I personally analyze the chart. Now, with all of this in mind, why am I not coming into this market yet? Very simple. You see this big 4 you have here, this big 4 that occurred here. It didn't happen by mistake. It happened because the BOJ saw the price of the dollar to the yen at 160, the yen to the dollar at 160 and intervened. And this is not the first time. If you're new to forex, you should know this. I should tell you this in case you're new. If you're not new, you know this. So I'm going to zoom this chart out and you'll see just by looking at this small portion. What do you see over here? Is that when price is here, price is ranging, but this is just a small portion of it. Let's take a look at over time. So as you can see, in the past, we've had this same scenario here. You see this same price area just above the 160 to 161. Actually, before that, we have the 161, 160 appear and fall. It went above that level. It fell even harder that time. You can see it was a clear warning. It fell harder. It came up, getting close to that same level again. We had that drop to the downside. We've had that appear again multiple times. This is several warning in one location. So if you're new to trading, I'll just give you one simple advice. Avoid the US dollar against the Japanese yen for now. It is not a clear cloud. If this market wants to crash, it is going to crash hard and fast when it wants to crash. Trust me, it's something that you should be very, very, very careful at all with. If you even want to take a trade, take it with the smallest lot size you can ever take in your account. I mean smallest. I mean the tiniest lot size that even if the price moves 100 pips or 200 pips against you, the loss would not be deafening or painful to your account. That's all I see here. So this is the analysis of the 5 markets I'm currently looking at, and I hope you enjoyed it. If you learned something new, do well to hit the subscribe button, hit the like button, share this video with someone who you think may find this analysis very useful for their trading career. I'll catch you all in the next one. Peace.